Hey everyone, today I want to talk a little bit about mortgages and whether or not you should pay down your mortgage or overpay your mortgage or invest. So if you have a lump sum or if you have additional money every month and you're wondering, okay, interest rates are going up, my mortgage repayments are also potentially going up, how do I bring those down potentially by paying it down? Is that a good idea from a financial perspective? And so there are two real considerations here. The first is financial considerations, and the second is kind of emotional and behavioral considerations. Um, so, from a financial perspective, um, it's a relatively straightforward assessment. So, at least conceptually. So, when you overpay your mortgage, then you're going to guarantee yourself a return on that money that you've overpaid equal to the interest rate on your mortgage on that money. And that's because you're going to be reducing your monthly payments or the interest component of your monthly payments by an amount equal to your rate multiplied by whatever you've paid in. So, for example, if I overpay my mortgage by £1,000 and my interest rate is 5%, then I'm going to reduce my monthly or my annual interest payments by 5% of 1,000, or in other words, 50 quid. Um, so that's kind of your return on the money that you've invested. The alternative is to invest that money into another asset class. So, for example, you could keep it in cash, keep it in your bank. You could invest into bonds, which is basically like debt. But you would be the lender and you're getting a coupon, you're getting interest on that money. Or you could invest into stocks and shares. So, if you have a long term time horizon, by which I mean more than 5 years, and ideally 10 years or more, then stocks and shares have historically given the best return on your money. And so, if you were to invest into a globally diversified equity fund, low cost with somebody like Vanguard, then you can reasonably expect roughly an 8% return above inflation. Now, it may be slightly higher, it may be slightly lower, and in a shorter period of time, it can definitely go down as well as up. But that's broadly what you can expect. And so you might just think, well, if that 8% notionally is more than my mortgage interest rate, then I should definitely just invest in stocks and shares. Now, it's slightly more complex than that because what you have to factor in is that there are some other considerations at play. So the first is that the money you get on your mortgage, the return you're getting on that money is guaranteed. So there's no volatility, there's no risk. It's an absolutely guaranteed return. And for many people, that's very attractive. The other thing is that it's a tax-free amount. Because it's money that you're not having to pay out rather than money that's actually coming to you, there's no tax on it. Now, if the alternative for you would be to invest in an ISA, for example, then actually that doesn't really matter as much because anything that happens in the ISA is going to be tax-free as well. But if you're in a position where, for whatever reason, you've either maxed out your ISA or you don't have access to an ISA, then you also have to think about what the tax would be on any returns you make in the kind of alternative investment. So, for example, in the UK, capital gains tax on stocks and shares is 20%. So, in order to make that 5% return, you're going to need a kind of 6 and a bit percent return on your stocks and shares. So historically, when interest rates have been really low, 1.5%, 2%, it's been quite straightforward in terms of the economically rational thing to do is to invest rather than to pay off your mortgage because it's relatively easy to get a return that's better than 2%. As interest rates creep up, that assessment becomes less clear. And so, at the moment, I think rates are about 6, even 6.5%. And so, if you're able to get a guaranteed risk-free, tax-free 6% return, that compares relatively favourable to an 8% return in the market, which comes with risk and volatility and taxes potentially. So, depending on your mortgage and your circumstances, the right thing to do will vary, and also to do with your tolerance for risk. If you're really happy taking risks that are compensated, so these aren't uncompensated risks. If you're happy taking those risks, you might think, okay, my mortgage rate's 5.5%, 6%. I think I can get 8% in the stock market, and after taxes, this works out slightly better, so I'm going to have my money in the stock market, and that's completely fine. You might also think my mortgage is 4%, but I'm really risk averse. I really don't like taking any risk, and so I know that it might not be the optimal use of my cash, but I'd rather pay down my mortgage and have that sort of security, which is also completely fine. Now, the second thing I wanted to mention is kind of their behavioural and emotional component, which is something I've sort of just touched on there with everyone's different tolerance for risk. So for some people, paying off their mortgage is a kind of lifetime goal and a big achievement, and something that they'll be proud of and they want to work towards, and they don't like the idea of having this big debt over their head. And if that's you, then feel free to pay down your mortgage. There's nothing wrong with that. What I would say is, if you're still on a lower rate, so let's say you fixed for 5 years in, I don't know, 2021, it's worth kind of considering whether or not, if you've got a 2% rate, yes, you can pay it down now, but what you could do, for example, is to put that money that you would otherwise pay down your mortgage with into a savings account, because at the moment you can get 5.5% on 1 and 2 year fixed savings accounts. And so if you are somebody who doesn't like taking risk, you can still kind of take advantage of the fact that if you have a lower rate currently, you could put money into a savings account, get a higher interest rate, and then when you come off your fixed rate mortgage, you could then take the lump sum that's in the savings account and pay down your mortgage at that point. So you'll be benefiting from a kind of a 3.5%. Let's say you were on a 2% rate and savings rate's 5.5%. You're benefiting from that extra 3.5% for however many years that goes on for. And that's a kind of no risk way of doing it, especially if you're below that 85,000 FCS amount that the government will effectively cover if the bank went bust. So some things to think about. There's not a right or a wrong answer when it comes to paying down your mortgage, but hopefully that's helpful in terms of how you can think about it and make the decision that works best for you. One other thing that I wanted to add is that if you are coming up to remortgage, as well as looking at the potential interest rate you'll be paying versus what you might get from investments, it's worth looking at your loan to value, because if you are, for example, at 19% loan to value, so let's say, for example, in a simplified example, your house is worth 100,000 and your outstanding mortgage amount is 81,000. When you come to remortgage, you'll be in that effectively 15% loan to value bucket, because typically they jump up in increments of 5 or sometimes 10%. And so if you're with your £100,000 house, if you want to get a mortgage for let's say 95,000, so you're putting down a 5,000 deposit, you'll be getting more or less the worst rates. I think there are a couple of 100% mortgage products that have just come to the market, but generally speaking, the higher your deposit, the lower the rate you'll get, and that kind of jumps in steps. And so if you happen to be at near one of those steps, so let's say you've borrowed, your remortgage would be for 81,000 from a £100,000 property, it's really worth looking at what the rate would be if you only borrowed 80,000. Right, so if you can just fund that 1%, sometimes there might even be 0.5%, what can be a relatively small amount. If you could fund that extra, that might bring you down into a lower interest category. So it might bring your headline rate down by maybe 0.25%, 0.3%. It could be quite significant. And so if that can be the case, that will effectively give you an outsized return on that money. So if you can, for example, to use just a very simplified example, let's say you could borrow £81,000 at 6.5% interest, but if you find that extra £1,000 somewhere and you can pay that, and you step down into the 20% loan to value, and that means that you can borrow at 6%, then your return on that £1,000 is equal to 6% on £1,000 every year, but also onto that difference between the two rates of 6.5 to 6, so at 0.5% on £80,000 every year. And so that's really quite a lot of money. So I think 0.5% on £80,000, about £400, plus your 6% of £1,000 being 60 quid. So you're then, £400, 6% of, anyway, my numbers, mental maths live on camera, not a good idea, but you're sort of going to be looking at nearly £500 a year return on that £1,000, which is an incredible, return. So if you are remortgaging, definitely something to think about. And also the last thing, which is slightly off topic, but while I'm on talking about remortgaging, if you are coming to remortgage in any time in the next year, this is important for you. So as rates continue to go up, it's important to be aware that mortgage offers are valid usually for 6 months. And so 6 months to the day before your fixed term expires, if you're on a fixed rate, it's worth speaking to a mortgage broker and getting a few offers, or getting the most competitive offer that you can, which safeguards you, because if rates continue to go up, you have that offer to fall back on. So, to use myself as an example, I recently had to remortgage in June. In January, I got an offer for like 4.5%, and by the time I got to June, rates were about 6.5%. So I've managed to save myself 1.5–2%, which is actually quite a lot of money. Similarly, if rates happen to fall, then you're not tied into that offer you got previously, and you can just get a new offer as rates come down. So I thought I'd just add that on at the end. Thanks for listening.